Welcome to TheoTRADE. This is Don Kaufman. It's January 12th, 2024. Just a few hours left in the trading session here on this Friday afternoon. S&Ps, as we record this, massively unchanged. Nevertheless, will volatility return with a vengeance? All right, let's jump right into that here on this weekend's update. You know, in the last 24 hours of trade, things are starting to get a little bit crazy. You know, if you tuned in right now and you're looking at the S&Ps and, you know, you haven't looked at the screen that much throughout the course of the day, you're like, nothing is going on, except everything is going on. So the S&Ps this morning, even pre-market, really started to break down significantly. They were down some 23 handles, and it was because of earnings, specifically out of the financials. Some rough earnings come out of the financials. All right, so it bids back up a little bit. Next thing you know, PPI comes out. We take off to the upside. But the key ingredient at the cash open, and we're going to talk about this extensively. Call buyers rush the marketplace. We explode to the upside, only to come back off again. Look, the range here, it's quite magnificent. And the reason I'm detailing this, because of course I'm asking the question, is volatility about to return with a vengeance? But the reason I'm really detailing this is for the very first bullet here on this weekend's update, and that is extreme call buying. It is what's driving order flow right now. And a lot of people are not necessarily aware of what that kind of entails. But this morning, we actually saw call buyers rush into the SPX in 0 DTE, and it exploded the marketplace higher. Allow me to explain in a bit more detail here, because this is the driving factor. It's not about, at this point, it's a MACD, it's a Fibonacci, it's a Bollinger Band. It's not about like a technical. It's definitely right now, there's no fundamentals behind markets. Okay, there's nothing. But this morning we saw extreme call buying. I've seen it several days throughout the course of this week. And again, I'm going to allude to it right here, right now. First and foremost, one of the things that you can see pretty clearly under today's option statistics, and this one is specific to thinkorswim, today's option statistics, all right, what you've actually got over here is obviously calls, and you've got puts. Now, immediately people look at this and they go, no, less calls are trading than puts. That's actually not what we're looking at. What we're looking at is this morning, right out of the gate, okay, specific to the SPX, and I saw it in the spiders, and I even saw it on the ES options and futures. What we actually have is in every single marketplace, there's a bid and an offer, right? So let's say an option inside of the SPX is trading 1330, okay, at a market of, let's say, 1360. Now, yes, I'm making the market about 30 cent wide. I'll tell you what, though, during the trading day and those 0 DTE, some of the markets right now, I mean, they're amazing. I don't know if people have looked at this lately, and I'm not here to promote the SPX, but you have like 10 and 20 cent wide markets. But right at the open, it was about 30 cent wide this morning. And what we saw into the cash open was call buying, huge call buying. How do you know? They were just trading them at the ask or above. Just, you know, whatever. And there were literally thousands and thousands, and they just kept coming for them. I also noticed, though, it was being done via algorithmic order flow. And what that basically entails is they're actually breaking up the size, small chunks. There was not, you know, nobody was coming in there and like sweep 1,000. It was just, again, an absolute onslaught. And they were trading up at their ask or above. And again, if you're trading at the ask or above, okay, it is indicative of buy-side activity. And it was amazing, actually, into the open, because there was like almost nothing traded at the bid or below. Everything was traded at the ask or above. And what that basically does, okay, is it generated a rally. And I'll give you actually the lowdown of exactly how this does generate a rally. If you guys are unfamiliar with how market making works, okay, you're a retail trader. Let's actually map this out. You're a retail, right? All right, so there you are at retail, and you turn around, okay, and you buy calls. Now, retail traders could be buying calls, proprietary trading firms, okay, hedge funds, anybody could be out there buying calls, but I'm giving it to you from your perspective. You turn around and buy calls. When you buy calls, all right, when you're buying calls, who sells you those calls? Okay, the market maker. So the market maker turns around and does what? Sells calls. Doesn't even matter which calls. You can call them anything you want, but when you buy calls, what you're actually doing is exhibiting what we term positive delta, and effectively is bullish. When the market maker sells you those calls, the market maker keeps a little bit of edge in there. They say the calls, it exhibits what? Negative delta. They immediately, instantaneously have to offset their negative delta by doing what? By neutralizing it through positive delta. All right, so you want to keep that neutral. How do they get positive delta, especially in the SPX? There is no underlying. There's no underlying in the SPX. They come right over here and just buy S&P futures. That's their hedge. So the SPX, okay, is kind of the mother of all products, as I always call it. And they're turning around and actually using the S&P, okay, the actual S&P contract itself as the hedge. And of course, how do you hedge? You buy. So the sale of the calls is met with, of course, buying of the S&Ps. You basically get into a rather neutral position at that point. But if we continue to go up, they have to re-hedge, which means they have to buy more. Okay. And again, this morning, this is exactly what we saw. Now, I'm just mentioning specifically this morning, as I alluded to. I saw it several times this week. And it's crazy because it was so heavy this morning. I felt like I was back in like 2021. In 2021, this is exactly what was going on. We were seeing these huge number of calls being purchased. But what was unusual today was this actually hit right at the cash open, which again, we've seen this a lot, but it hit right at the cash open and it just completely and totally abated. And when it did abate, okay, the S&Ps, literally, they took off to the upside out of the gate. The second that call buying kind of abated, we dropped like a rock. And that is absolutely pivotal in today's marketplace because it is indicative, again, as I said, it's not about fundamentals, not about technicals over here, but it often does, okay, arrive at the same time as volatility. And that's why I'm actually asking that question. Is volatility actually about to return with a vengeance? Okay, now volatility, you can look at it a lot of different ways. You can look at implied volatility and historical volatility. Historical volatility is actual price movement. There's no question, though, something's changing in this marketplace. You look back again over the last 24 hours of trade, and it is Mr. Toad's wild ride of reversals. Obviously, this is Thursday's trade. This is, of course, when CPI came out. CPI was initially, it was a very negative until it was actually a positive for the marketplace, but keep that in mind. Again, we are seeing considerable two-sided trade return to the marketplace, but the marketplace has been dominated, okay, by extreme call buying. It is dominating the order flow. They're coming in, they're rushing the marketplace. And, you know, it literally, this marketplace is the cart, which is options, leading the horse, which is stock. All right. Next, let's actually cruise over to CPI and Fed fund probabilities. So one of the things I was mentioning ago is just a minute ago, there is a narrative out there. So the CPI print came out. And the reason I'm mentioning CPI, the CPI print actually came out hot. It is hot, which basically means inflation's starting to return a little bit. Initially, okay, that was a big time negative for the marketplace. A few hours into the trading session, the narrative totally shifted. And everybody goes, nah, it's okay. It's okay. I mean, literally the narrative shifted. It's okay. And of course, call buyers actually came out of the woodwork. And here we go. We're right back up. Right? You just cannot keep a good marketplace down. But I stress this to you about the narrative kind of shifting. What narrative shifted? Right? What was the narrative? You got to check this out because this to me is just, it really is all kinds of chaos. Now, I've brought this up almost every weekend update that I've done lately. And the reason I keep bringing it up is, hey, look, lo and behold, look, the January meeting, okay? And January meeting, of course, okay, of course, the January meeting is coming up in a few weeks, and there's what? Oh, there's almost no chance for a rate cut. Then you go to March. If you haven't seen this, you're going to be a little bit shocked. But by the March timeframe, what effectively do we have? That is a 20% chance. 20% chance they're going to hold rate steady. Rates right now are trading 525, 550. There's 525, 550, 20% chance. You realize right now the marketplace has an 80% probability because it saw the CPI number and they're literally, yeah, it's up, but it's still coming down. The probabilities of rate cuts, not hikes, cuts, went up and up substantially after the CPI print. And of course, as a trader, you're left in the dust going, well, what just happened there? At least I am at that point. And again, as I said, the narrative shifted. It doesn't matter what you think. Fed fund futures right now give an 80% probability to a rate cut in the March meeting. If you look out at May, okay, May, there's no chance. They're basically, look, at 525, 550, there is no probability for that. The probability at that point is that rates have already been cut. There's a 70% chance, okay, that we're already going to be down 475, 5. You know, it's insane to me. It really is. And this, okay, this is the real area where I'm actually asking the question, will volatility return with a vengeance? Because I have a tough time with that. Look, it's difficult as a trader, okay, to, if you will, want to take the other side of the marketplace, meaning that I'm literally out here saying like, no, this looks all wrong, okay? They keep increasing the probability of a rate cut in March. And again, it looks shocking to me. If there's any conversation piece, all right, next week, and again, next week, Monday is going to be a holiday. We're going to be in a 4-day trading week. But if there's any conversation piece next week, and next week is the last week really for Fed speak before they go into the quiet period, but any conversation that they're not going to cut rates, this marketplace is going to get wild, okay? We're coming down to it. So some earnings came out today. That didn't even drive, all right, volatility. And we're about to talk about that. But again, I stress to you that CPI comes in, it comes in hot. Yes, PPI came in today and PPI came in a little bit soft. So you have one of the metrics that's saying like inflation starting to pick up again. PPI is not nearly as inflationary in terms of indication, but PPI did come in a little bit soft. Nevertheless, okay, it's one of the reasons that we're seeing such significant two-sided trade. And again, for what it is worth, I believe actually we're about to see some pretty good volatility hit this marketplace. Look, I'm not going to sit here and preach to you that we're not going to hit all-time highs and then reverse off of them, okay? But big portion of me right now, you just take a look at like a 30-day 1 hour, okay? In the 30-day 1 hour, we've consolidated considerably in a range, but that range is chopped out, it's fast, and it is downright angry, okay? It is going to be an angry marketplace. So keep your head in the game as we actually drive not only into the weekend. It looks like it's kind of mellowing out right now, but keep your head in the game next week. More earnings coming out. I don't think earnings are really going to spark this, but Fed speak surely is going to be a conversation piece. Speaking of earnings, let's go to big banks. Big banks about as questionable as it gets. So this morning, again, I keep talking about like this narrative shift. This morning, the financials, they opened hot as can be. But actually, if you looked at some of the banks, and you just can't even make some of this stuff up, look at some of the banks over there, they're all over the place. And I want to bring the banks up for just a moment. So JP Morgan right now is completely unchanged after its earnings, and it spiked. It's actually faded a little bit. Bank of America, very similar. All right, Citi to me is probably one of the most shocking ones. If you haven't seen some of the news on Citi, okay, you wouldn't believe it until you actually read it. And I'm actually gonna bring it up right here, right now. This headline: Citigroup is cutting 20,000 jobs. And you're like, okay, well, is that bad or is good? Well, more often than not, cost cutting is actually positive for the stock. The next part of it, though, is the real kicker. It's cutting 20,000 jobs because it just reports the worst quarter in 15 years. It's the worst quarter in 15 years. And mind you, the stock is actually up right now. Forget about where it is today. The stock was actually trading 38. Straight shot basically to 55, and now it's actually having just a mild little pullback in here. People, okay, this is going to be worth watching in the days to come because, I mean, is this marketplace effectively priced? And at this point in time, again, I think it's dangerous. Like, look, I like to wait until earnings date +5 before I start to really execute into a product. But short side of financials, which I am already in. Okay, I've actually, put on a bearish in-out spread here. I've actually got a position expressly inside of JP Morgan right now that's bearish. Okay, I'm already in because the run-up here has just been nothing less than phenomenal, and nothing stellar came out of some of the earnings in there. Anyway, questionable earnings, and that, I mean, it drove huge volatility today, specifically to the Russell. Look at this thing. Okay, we're all over the place. Now, the Russell was also heavily impacted today by the energy complex. Energy complex is also very, very volatile. But the Russell, okay, I mean, talk about like some movement over here. And look, doing this, it just doesn't even do it justice. You got basically a 1966 product traded to 2000, completely reversed, violent moves. Again, bringing me, to the conclusion we might see some very serious volatility start to return to this marketplace. All right. The last, okay, but not least, when a market's actually going to get a dose of reality. Again, next week is none other than it's a holiday trading week. So Monday, markets close. Now, some of the futures markets are going to be open, but throughout the course of the week, you got to keep your eye. There's Fed speak throughout the course of the week. There are some more data drops throughout the course of the week. There's nothing nearly as crazy as this week. Like CPI is kind of a big one, okay? But any number, okay, any number of data drops that come out, even something as simple as like consumer sentiment, could absolutely rock this marketplace. And I am cautioning you right now, okay? Earnings are also going to take center stage. Now, I don't necessarily think it's earnings that's going to be the catalyst. It's probably going to be either Fed speak or some economic data. But you can actually feel a change in the marketplace right now. And as a trader, the one thing that I've always learned to do is you're looking at a tape and you're like, this looks all wrong. Okay. Yes, because there's change. There's change, out there. And it's literally some of that change is just in this last 24 hours of trade. With that, last but definitely not least, we look at the SPX. At this point in time, and again, you still have about 2 hours to go to the cash close, but at this point in time, we are most definitely outside the upper edge of the SPX expected move. Now, why am I so deliberate by saying that? Because we did the exact same. I mean, we actually cracked the low side of the expected move last week. We're to the upside of the expected move this week. The one thing you've got to understand is, I talk about like, volatility kind of returning with a vengeance. Okay, one of the first things you would see, one of the very first things you would see if volatility is returning with a vengeance is breaches of expected move. Again, consecutive breaches of expected move are the markets literally getting ripped apart. And you are, in fact, so you had a breach of expected move, obviously went 2 weeks into holiday trade, breach of expected move, breach of expected move. Things are clearly, okay, getting a little bit crazy. And the reason that the expected move and the breach of the expected move is so, okay, critical in terms of it, it's like a really objective determining factor for me. And the reason being is, I mean, there are billions of dollars resting on the idea that you're supposed to close inside of the range. And the range this week was basically plus or minus about $60. So you had a 5-day trading week. You're supposed to move plus or minus $60. Did we? Okay. Yes. And then some. I mean, we moved over $60 basically in the front of the week. Huge call buying in there, right? The rest of the week, we just skirted the upper edge of the expected move. Today, we broke a little bit higher, but you know what? The day, it's not over. Okay, it's not over. And there's several instances literally today where we tried to reach back for the upper edge of the expected move, got a bid back under us. But as I said, it's not over. By the way, the upper edge of that expected move is 47.58. Could we pull back to it? It is unlikely given some of the lack of movement, at least at this point in time. But again, this is something to really think about. You start off the year and you're like, it's not much to start off the year. It's kind of mellow. And we're actually starting off the year with a bang. 2 consecutive breaches of expected move. What are we looking at for next week? So next week, as I had mentioned, okay, There is no Monday. There is no Monday. Markets are effectively closed for the Martin Luther King holiday. So we look out 7 days. What do we see over here? About a $56 expected move. So, and that's probably going to subside just a little bit, given the fact that some time is going to pass between now, obviously, and the close. But ballpark, mid $50 range, which, okay, very, very similar to this week's expected move. But again, we're moving into a 4-day trading week with about a $55 expected move. At least from where I sit, having looked at the previous two expected moves and watching those two expected moves get shattered, I'm going to tell you something, okay? I wouldn't sell any short duration options when you're getting that kind of movement. Again, intraday trade right now, okay, should be a little bit intimidating to you. It's not easy. As I said, there are changes all over this tape. Okay, there's divergences all over this tape. Earnings does have some role in it, but I really think that this is a tremendous amount of confusion in and around, okay, that inflation, that whole paradigm, it's all over the place right now. And again, Fed and Fed fund futures, expect them to shift wildly here in the next few weeks, which is exactly why I, for one, think volatility will return with a vengeance. Thanks, everybody, for joining us here at TheoTRADE. Have a wonderful holiday weekend. Bye-bye.